You're probably paying too much in taxes when it comes to your capital gains because you simply don't know the rules. In today's video, I'm going to show you how capital gains are taxed and how to use the rules to your advantage to pay less money in taxes and keep more money in your pocket. Let's jump in. So the first thing you need to know is a capital gain is a gain that's realized when you sell an investment at a gain. And the first key is there's short-term capital gains and long-term capital gains. And let me tell you, short-term capital gains are bad. You want to avoid those because they're taxed at ordinary income rates. A short-term gain is any investment that you've held for less than a year and you sell it at a gain, it's taxed at short-term gains rates. A long-term gain is an investment that's been held for at least 12 months and a day and then is sold, and that's taxed at the more favorable long-term capital gains rates. Let me show you. In this country, here are the marginal tax brackets right here, and they start as low as 10%, they bump to 12, they go to 22, 24, 32, 35, all the way up to 37%. So you can see that if you're realizing ordinary gains, you can pay quite a bit of money in taxes because you're not being smart with the timing of your gains. On the flip side, if you hold the investment for 12 months and a day, if your income is below $89,250 for those who are married filing jointly, if you're below that, you could be paying zero in long-term capital gains. That's right, you heard that right. Tax-free gains by knowing the rules and using them to your advantage. So this is based on your taxable income here. And if you're somewhere between $89,250 all the way up to $553,850, you are now, those long-term capital gains are now taxed at the 15% rate. So 15% is a whole lot better than, say, 22 all the way up to 37. 15% is much lower. So at the very least, for many folks out there, you're going to find yourself in that 15% capital gains rate. Make sure your gains become long-term. For you higher income earners whose income is $553,850 or more, your long-term capital gains rate is 20%. Which is a whole lot better than your ordinary income rate, which would be somewhere around 35 or 37%. So again, be smart with the timing of when you realize gains. And I would encourage you, if you ever find yourself in that 0% capital gains bracket, take advantage of a strategy that I like to call tax gain harvesting. Selling those gains and paying nothing in taxes, and then replace the security that's sold with something that's similar to help your investments stay invested and continue growing as markets advance. That's the best way to use tax gain harvesting to your advantage. Now I want to talk about a situation that I see that comes up when people go and sell their home for a gain. With all the appreciation that we've had in the real estate market over the last few years, there's quite a few people that are finding themselves with a large amount of equity in their home. And so I want to make you aware that if you sell, let's say you sell a home and you realize, in this example I'm using, a $600,000 gain over and above your cost basis plus your Section 121 exclusion amount of $250,000 per person. Let's say that you're realizing an extra $600,000 of capital gains. This is an example where you could find yourself going from the 15% bracket up to the 20% bracket, and that's what you want to be careful of. So if you're thinking about selling your home, make sure that you're tracking your cost basis. So it's your purchase price plus any home improvements that you've done on the house. That gets added to your cost basis. That becomes your adjusted cost basis. From there, you get $250,000 of gains that you can shelter or exclude, and if you're married, you get $500,000. And over and above that, any gains over and above that are going to be added to your tax return. And so you can see the example right here where there's enough gains that this person was bumped from the 15% bracket up into the 20% bracket. And this can have negative impact on your Medicare planning, because as you go to apply for Medicare, they do a 2-year look back, and if your income is over certain amounts, then they apply a surcharge to your Medicare. So those capital gains can not only cost you in additional taxes on the gains, it can also cost you in additional expenses on your Medicare premiums. So watch out for those time bombs. So as you can see, there's so many rules to the road when it comes to how capital gains are taxed. And understanding the rules and understanding the strategies is key to helping you save money on taxes and building wealth over time. If you want assistance in doing this and you want help on your journey, please feel free to reach out. My team and I are here and we're happy to help you if you need help. And our goal is to help you save money in taxes and really create peace of mind when it comes to your finances. Also, make sure to like and subscribe the channel and share with anybody who you think can benefit from this, and we'll see you on the next one.